Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
All right, Kevin, welcome to Pilot Money Guys, man. It's such a privilege to have you on today. We have rescued you from the tax cave, so welcome aboard.
Yes, I'm really excited to be here, and it's nice to talk about something else other than a deduction, a credit, or income. So thank you, Charlie.
Although if you have any good tax saving strategies, those are always good to throw out there. So I'm kidding. We kind of know some of those things, and you have been in the tax cave. So thanks for what you're doing there. I'm glad that you're coherent and awake, because it's a tough, we're coming down the home stretch there.
That's right, Charlie. And today we're doing this podcast video on the 3rd of April. Mm-hmm. And so the market's down pretty big today as we talk. And anyway, I just wanted to timestamp that, and that might influence some of the things that we talk about.
Absolutely. In fact, there are a couple of things we need to talk about first, but it's hard because, there's a feeling of urgency right now as today is really pretty nasty day on the market. So we will talk more about that in a minute. But first, Kevin, we want to thank everyone for rating and reviewing the podcast and sharing it as well. It's super helpful, helps us to get that to more of our pilots out there. And hopefully we can help more people with that, with the content that we put out there. So we really appreciate that. Thanks for the ratings. And the last rating was Jay Stouffer. Thanks for doing that. And then he recommended we eventually cover the market-based cash balance plans, which we will, Kevin, and we'll put out some specific YouTube material to that as well. But so Jay Stouffer, thanks for that comment. Thanks for the rating. We appreciate it. And also check us out on YouTube, because we're going to share some charts today. We're going to be able to talk to some of the things there a little bit as well. So this will also be on YouTube as far as this podcast is concerned.
If you want to comment, YouTube is easier to comment than anywhere else. So that's really where, if you have comments or questions, if you want to ask us anything, we would love you to put a question in or a comment on YouTube.
Perfect. Yeah. Thanks for that, Kevin. But anyway, so check us out on YouTube and leave us some comments, questions. And also thank you for those that are doing the Pilot Wealth Index. If you look at, if you're looking at your, or listening to this podcast on Apple Podcasts now, no longer iTunes, I think, you can click on the hyperlink there, take the assessment. And our hope there, our goal is that it helps you to understand where you are in your journey to retirement or financial health and prosperity. We designed those questions, Kevin, to help give people just an indication. Are you thinking about the right things? It's really hard to do that when you don't know your audience, or you don't know someone specifically. But we think if you can answer those questions like, hey, am I doing these things? Then you've done pretty well as far as taking care of your financial house there and have a good, strong financial foundation. So check it out, take it, and let us know what you think. So anything else, Kevin? What do you think?
Yeah, I mean, just mission number one of the podcast, YouTube, is to educate. And so we just appreciate anyone giving us feedback or, taking the Pilot Wealth Index. It sounds like we're doing a commercial there, but anyway, our mission number one is to educate. So that's what we hope to do.
Absolutely. Awesome. So speaking of education, Kevin, before we get into the market stuff today, which is, again, pretty, I'll use the word exciting, maybe not always in a pleasant way, but nonetheless, we need to talk about I-bonds. They're a lot less sexy than what's going on right now, but still the timing is right. We've had this on our list for a long time, just to kind of update people about I-bonds, because over the last couple of years, there's been some interest there that they could have captured. And so I know a lot of our clients did that. I know we've done that. But now the interest has come down on I-bonds. Right now it's 3.11%. And I think that was adjusted as of last October.
There is a time period if you wanted to cash out your I-bonds. First of all, when you do cash them out, they will be taxable at that point. If you've had them for years, there's been no tax you've had to pay on them. But you're exactly right, Charlie. We wanted to wait until we got to the low 3.11% because you do lose some interest. I think it's 3 months of interest by cashing them in before 5 years. And so now is the time.
Yeah.
You wanted to cash them out, you could, and you would only lose a quarter percent, or not a quarter percent, a quarter of 3.11. I can't do that math.
I know I can't either. I can't even double check you right now. I'm not quick enough. But 3 months of interest and is what you'll be penalized if you sell prior to 5 years. And again, now is a good time to do it because that lower interest has been in effect for more than 3 months. So if there are other alternatives that you want to do with the funds, need a new vehicle or something, or want another place to invest. I think the other thing, Kevin, there, before we move on from this one, is what are your alternatives? Can you go somewhere and get better than 3.11? And that answer is probably, maybe 3.5, high threes possibly. So it just really depends on your alternative options as well.
Yeah. So, the risk-free rate of return, I mean, these I bonds are considered to be risk-free or close to risk-free because you can get the money back anytime after a year. The risk-free rate of return, I think, is somewhere in the high threes now for a 90-day, but it's come down a lot in the last few weeks. So but if you're not going to do all the work to get it into another type of bond and you're just going to leave it in your bank account, it earns zero. That's worse than 3.11.
Yeah, there you go. So give us a call or email if you have any questions on the I bonds. We can try to get on a call with you and help you out if you need help making that decision. But Kevin, let's move on to the main topic of the day. And right now, again, staring us right in the face is potentially, it's definitely a bad day on the market today, but potentially a bad market in general. We don't know. And that's what we'll talk about. We're going to talk about uncertainty, how to survive, even thrive in uncertain markets. What do we do in times like this? I should say, what have we learned? And so we're going to go down that path, but it's pretty fascinating. And big picture, what we'll talk about today is what is the mindset or perspective? And I'm a big fan of that, Kevin. We're going to get into some nitty gritty numbers as well, possibly that could help, some historical things that we've learned. But what I love to do during these times is revisit, how we should be thinking, and not should be, right? How we might be thinking that can help us get through these things. And it's not easy, that's for sure. We realize it's a challenge. And so we want to try to help kind of have the right frame of reference. But what are your thoughts on the current?
Yeah, don't shoot on me, Charlie. Nobody likes to be shooted. But one thing I'll say first before we get to the question that you asked is that the 3-month T-bills are actually 4.3%. So Charlie, to answer your question, I am very lucky that I started in this business in 2007. And the reason I say I'm very lucky is I went through 2008, I went through 2009. I needed to figure out how to survive. They said that financial planners had a very high rate of post-traumatic stress, or whatever they call it, after the crash of 2008. Now this type of lucky, this is like my friend Rob, who was talking into a fan at college, and he got so close to the fan that it just slit his nose right down the side of his nose. It slit it, and he had to get stitches. And so I told him, man, you are lucky that you didn't get your nose chopped off. And he said, look at me, Kevin, do I look lucky? And so maybe that's the way I feel a little bit about having gone through that market crash. But Charlie, I really think as investors, human beings, people, we really want to discover a way to be at peace with what comes our way. And I think that's really what our mission today is.
Yeah, absolutely. And I want to talk to, why do we hate uncertainty? It's just one of these things as human beings that we just do not get along with well. And not to mention in the world of finances, there's a lot of confusing information surrounding us, i.e. news headlines constantly, whatever your Google feed might be feeding you. We'll talk about some of those things. But right now, let's just kind of frame where we're at, the state of the markets. We've had a lot of President Trump is in office. We've had a lot of unexpected announcements. Whether they're good or bad, Kevin, we don't know yet. We may not know for years. And so we're not obviously going to be political. We'll save those for conversations for other people. But we know that markets don't like surprises in general. In fact, we often say it's not the event itself that affects the market. It is the the unexpectedness of it, whether that be good or bad. And right now, since the beginning of the year, there's a lot of unexpected things going on. Mainly, I would say mainly tariffs, some government layoffs, some things like that. So there's a little bit of fear out there, and I think the markets are reacting to those unexpected events anyway. Kevin, anything to add to that?
Yeah, I mean, the market really is an information processing machine. And what I mean by that, Charlie, is people every day are deciding if they want to buy or sell. And, less people really want to buy. And, today is a day when it looks like most of the people want to sell. Again, there has to be a buyer and a seller for all transactions. But yeah, that's what we've seen. We've seen the market kind of tell us that, people are afraid. And that's the reason why volatility goes up. And that's the reason why the markets have gone down.
Yeah. And volatility and uncertainty. In fact, that risk, we could use the word risk for all that, right?
Mm-hmm.
It's interesting. That is the reason why there's a return in the market in the first place. And sometimes at this very moment in time, that is really hard to process right now. Like these downturns are the reason why there is a positive return over time in the markets. But it is interesting right now, as you've said, the markets are reacting, and in fact, who was it? Benjamin Graham said the markets in the short term are like a voting machine, and that's what you're alluding to, where people right now are voting with, quite frankly, emotions. We don't know a lot of things, so at this point in time, Kevin, it's fascinating to take an inventory of how we feel about this, and I'll just say that, there's not a lot of sources of information right now, just like in 2020, that you can go to and go, oh, this is what's going to happen. So-and-so expert's going to tell us what's going to happen. That's just not in existence. It's only in existence after the fact. And at this very moment, there are a lot of uncertainty and there's a lot of uncomfortableness, people looking for solutions, and they're just not there. The future is absolutely unknowable, and we got to get comfortable with that.
Yeah, well, I'm uncomfortable right now, Charlie. I mean, you're uncomfortable. We don't like when markets go down. Our clients feel stressed. Everybody feels stressed. And one question that often gets asked is, is the market more uncertain at certain times than it is at others? And there's always that risk that's present in stocks, and that's why they've had such high returns, as you've mentioned. It's not a bug in the system when stocks go down. It is a part of the whole reason why expected returns are high, because it's very hard to stay the course when markets go down. And the best time to have been an investor in the last couple of decades was 2009 March. And by the way, the news was so bad in March of 2009. I remember the date when it bottomed. I remember a conversation I had with a client. We still joke about it, but it really was dark. And what also happens now, and this happened a little bit then, but not as much, is that when markets go down, you actually notice all the articles that are coming out that are bad. Every day, Charlie, we hear from some client that tells us the market is going to crash. They send us an article. It's a doomsayer saying the market's going to crash. But now, when you see that article, boy, it makes you a lot more scared. I mean, have you had that type of reaction to some of the news you've seen?
Yeah, because, like you said, it's now associated with real events and real, on your statements or on your screens, you can see your dollars going down, and that's alarming and creates that, flight or fight or flight response in us, right? But Kevin, right now, just to be more specific, we've got tariff wars in the news headlines. We've got dollar crashing in the news headlines, higher inflation, stagflation's always thrown out there, it seems like,
Yes,
just about every time. And talk to us about this feeling, this thing that we always say, when we say, everybody says it's different this time, and it is different this time. And that's kind of what I'm getting at. But tell us more about that as far as how do we handle that feeling? It's different every time.
Well, I mean, COVID is the greatest example of it's different this time.
Mm-hmm.
But what ended up happening is, like every other time, at least in history, we can't say what's going to happen in the future. But companies were making, bleach products and all kinds of stuff, and they figured out a way to make money, although the economy shut down. And we came out of that. And, but when the market started going up again, Charlie, COVID was still raging, and nobody knew when it was going to turn. And so this time is the tariffs and all this other stuff. There's always the old favorites thrown in, as you said, like stagflation and other things. They always get thrown in when markets go down. But it's scary every time.
Yeah.
And if you go back and you look at what happened during certain market events, it's scary.
Mm-hmm. It is. It is different every time. It feels different. The circumstances are different. The one thing that we can go back though and look at is history. Again, all we have, the data, history to learn from. The result usually can turn out, well, so far in our U.S. history anyway, it's turned out okay. Let's just say that. You know what I mean? After you can kind of look at the data and go, recessions have lasted this long in general, market downturns have lasted this long in general, and they've come back. So it feels different every time. The events are different every time. But so far in our market history, it's recovered and come back. We don't know, if that'll always happen that way, but that's what's happened in the past. And we do have that piece of information, which is helpful sometimes to lean on that because it's all we have.
Yeah. And Charlie, I know we're going to get into the way our brains work, but our brains sense fear very, very quickly.
Yeah.
Your money, your brain, Jason Swag said it's a millisecond that your mind can go to a dark place. And that's because of our reptilian-like brain that takes over in times of danger. So, what are your thoughts about that? And do you have any thoughts on how we might be able to deal with this if everything does turn out all right? A year, maybe even next week. You never know with markets; things could reverse next week. Yeah. But so we don't want to say it's all doom and gloom. But how do you get through these times of that brain hijacking the rest of it?
Yeah, Kevin, it's interesting because you asked me yesterday about a flying example. And sometimes the world of flying, people use cheesy analogies like the glide path to retirement. Okay, whatever. That's nice.
That's one of your favorites.
Yeah, one of my favorites. But what I really do believe is that the world of flying, whether that be military, airlines, whatever, and the world of investing steal from each other. And what I mean by that is, for example, risk management. In the world of flying, risk management is a big deal, and you talk about it a lot. In fact, audience will probably laugh a little bit, but we have the risk RRM model, and I'm almost forgotten the acronym by now, Kevin. But risk reward model, I don't know, but it's really, if you change a couple words, it's the same thing. And you asked me yesterday about a good scenario or situation, and it always reminded me of flying into Chicago Midway at night. You're 100 miles out. You're trying to get weather information. Maybe it's snowing. Maybe it's windy. Chicago Midway, for those of you that don't know, is a short runway. Very unpredictable winds coming off the lakes there, and changing conditions really quickly. But when we first started talking about that, I was like, but pilots they're trained for that. They can deal with being comfortable with that uncertainty and knowing that when you get that ATIS information or when you get some other information, it may not be accurate and it may change. It probably will change, and it might be worse when you get there. Mm-hmm. But I believe, and here's where I think the lessons learned can transfer. As a pilot, you're trained for that. You talk about it a lot. You're used to it. You have experience with it. And I think that's why pilots can become comfortable in that situation where there's unexpectedness, unknown, uncertainty, and actually be comfortable in that and make good decisions. And I think that's something we can learn, Kevin, as investors, but it does take some work. How do we train? How do we, as investors, how the heck do we do that? You know what I mean? So that's one thing I think that kind of resonated with me as far as the transferable skills, if you will, not just a fun analogy. But any thoughts on that, Kevin?
Yeah, I would just say that I like the analogy a lot. I'm not a pilot, not even flown a flight simulator. But the only part of it that kind of goes off track for me is, we talked about this yesterday too, is that you can always divert.
Yeah.
So, you can divert to another airport if it's too bad. Mm-hmm. So with investing, all those things are the same, that, you know that this is coming, what could happen, but you don't know everything that could happen. But diverting in the case of investing would mean to maybe go to cash or just wait till things are calmer, Charlie. And we think diverting in investing is usually a mistake. At least it's again been every time in the past.
Mhm.
Or sometimes people get lucky and they get out at the right time and get right back in at the right time. But for the most part, diverting is bad. So
Yeah.
what do you think about that idea of like, yeah, you're coming into Chicago, but you must land. You got no choice.
Yeah, yeah, exactly. That is where our analogy slash lessons learned may not transfer so well. But in the world of investing and personal finance, I think you got to have an equivalent divert option, and maybe it might be cash in the bank, Kevin. You know what I mean? We've seen in past scenarios where when times get difficult, and I think this is a takeaway for today. When times get difficult, markets go down. I think someone that has low debt and a really healthy, whatever, I'm being vague intentionally there because I don't know what healthy means to each individual, but a healthy, let's call it cash balance, maybe emergency fund outside of their retirement, they are able to withstand those storms better. And I can't even put my finger on exactly why that is. I think it's a comfort thing, but we saw that in 2020. Low debt, strong personal balance sheet, a healthy amount of cash outside of your retirement accounts, people kind of were able to manage those turbulent times a little bit better. So maybe that's our divert analogy. How about that?
Well, I would also say that, we're not telling you so. Like, hey, we
Yeah.
told you to have a strong balance sheet. Once, if you're listening to this podcast and you got lured in like everyone did, that, Nvidia became a better riskless asset than treasury bills did. They said at one point that there was some survey that it was, just better to put money into Nvidia than treasury bills. And, stocks could do nothing but go up, Charlie, and maybe they will continue to. But if you got lured into it and you went too much stock, other than just saying, hey, stay in your seat, don't sell, is there anything else people can do at this point? I mean, is selling a little an option at this point? The market is down more than 10%.
Mhm.
Is there anything that you can do, Charlie?
Yeah. I think it's a different discussion when you're talking about if you own, let's say you own NVIDIA only,
Yeah.
right? That's a different discussion than if you own an well-diversified, portfolio of, globally diversified investments. And you and I know that we can confidently say we should not sell because it's broadly diversified. But if you own an individual stock, unfortunately, all bets are off. We don't know if those companies are going to be around when these storms pass. And so probably will, but these big companies do go out of business. And sometimes these larger companies go down in value and they don't come back. And that's why you and I don't believe, single stocks only or fewer of them is the solution, because you can't say that when you get into a downturn anyway.
Well said, Charlie. And I think reframing the thought process in our mind is actually, like I believe in saying positive things to ourselves when things go bad. I think we have to do that. Believing as if everything will turn out all right. I think that's a good thing. I mean, you always have the choice when markets start going down and when the doomsayers come, is that you can say, yes, this time is different. Or you can say, look, I'm going to believe that everything's going to be okay. You check out your portfolio. You see that you're really very well diversified. Some of the things that we used to hate owning, like bonds, they're up a little bit this year. And if you have 8,000 companies, Charlie, what's the chance that 8,000 companies are going to go bankrupt? And if they do, we got bigger problems. But so that's really the benefit, again, of diversification and owning a lot of companies. And that's what we believe in. And that's why I think our framing of the thought process here is that we're going to be okay when we go through these types of events.
Yeah. I love the word you use there. And it's belief. We really have to have this basic belief that, again, if you own hundreds, maybe even thousands of great companies, that they're going to, the vast majority of them will survive. They will come back. They will be okay. And you own parts of them, even though their prices are down at these moments in time for whatever reason. Those are companies that you want to own, and it does take a little bit of faith and belief, at certain times like these maybe. So it is pretty interesting, and so that's when you alluded to the lizard brain earlier, because a lot of times there was an example. I was reading someone that talked about they were teaching their daughter to swim underwater, maybe across the pool. And that's a scary thing where your lizard brain is going to send a signal saying you're going to drown. Like when there's no other evidence against it, like even in the market, sometimes there's no other evidence that it's going to recover. Possibly could continue going down, but the lizard brain is loud, Kevin. In fact, the story that this guy was like, I was telling my daughter, you're going to swim underwater the whole way, and about halfway there, you're going to hear a voice in your head that says, "Stop! You're going to die, you're going to drown," and just continue through that voice, right? And our brains are meant to be wired that, or they're worked that way. And so it was so funny because his daughter made it to the other side of the pool underwater. And he said, "Hey, how did you do it? And how did it go?" And she said, "Man, that lizard is loud." So it's kind of, right now, that lizard brain of ours, it might be really loud. And sometimes we got to press through that, based on our plan and our perspective and the things that, we've talked about. But Kevin, what do you think? Any other things to help?
Yeah, I think, when I first became a advisor and people called and markets were down, I tried to educate them on how markets work, and most people couldn't get there. They were still in the lizard brain mentality. Just get me out. I'm in pain, and so I've learned over the years that we truly are in pain. Losing money, is 2 times worse than gaining a dollar. It's worse to lose money. So I think we need to start with that with ourselves when we are an investor. If you don't have a financial person, a coach, a planner, whatever, is just start with the fact that, yes, I'm upset. And again, you and I get upset sometimes. We just don't act on it. Did I think the year the market might be down? Yeah, but I just didn't act on it because I really don't know. Nobody knows what's going to happen tomorrow. So I really think we need to have some strategies to convince ourselves to allow the lizard brain to be quieted.
Yeah.
And there's a few techniques that I think we can do to quiet the lizard brain.
Yeah, absolutely. And, that was kind of phase 1 of our discussion, is this emotional reaction, this lizard brain discussion that we're having. But the little girl, the 7-year-old girl that was learning to swim underwater, was able to do it because it had been done before. There was data that showed it's possible. It's very doable. If you only do these specific techniques, it will work out okay. And again, there's no will in the world of investing, but nonetheless, in our example of this swimming, there is data that helps. So step 2 of dealing with all this uncertainty, volatility, this uncomfortableness, is basically the planning that you alluded to, the planning, the historical data. But one of the things that you specifically said earlier was zoom out during these times. Tell us more about that.
Yeah, so it's really well known that if the market is down in the morning and is up in the afternoon, and it finishes up in the afternoon, that you feel fine. And then if the market is down for a few days in a row, and then at the week it's up, you're fine. Same thing with the year. The market is down, Charlie. I don't know the number. You might have it, like maybe 14% at some point in time during the year. The market is always down. But if it finishes up at the end, you're fine. Yeah. If you actually are looking at a chart right now of year to date, you're going to see that the market is really down, and that's going to be depressing. But if you zoom out and you see, like maybe back to 2000, it would be nice to show Quanti back from 2000, which is our software to track investments, that actually you're way up. And then you zoom out even more and say, when am I actually going to retire? Charlie, we have the slide with the water jets over the airplane, and we're saying that you should actually try to zoom out emotionally that far and say, are the events that are going on today really going to affect when I retire? And so So that's what I think about zooming out. When you look at data, there's the picture.
Mm-hmm.
When you look at data over long periods of time, it's very different than the day to day. Being in the fight is not really helpful for investing. And so, picture your last day of work. Are you thinking about the investment returns? And this slide is 2023, 2024, 2025, or the investment returns you got over your career.
Yeah.
Probably the more important one, not probably, definitely, would be over your career. So chasing returns and making yourself emotionally ill really can hurt you in the long run. And I don't know how it's helpful. I used to think it was maybe helpful to watch CNBC and read news and wallow in it because I wanted to be informed. But I don't know, Charlie, do you think it's helpful to wallow?
I think no, it's definitely not helpful to wallow in it, or waller, as we say in East Tennessee, right? But
Yeah.
but no, not helpful. But I do believe there's a balance of being aware, and that's a hard balance to strike sometimes. And but I love what you're talking about, Kevin. This zoom out, and that picture on the screen that we showed for those that are listening is just an airplane, a retirement with the water cannons. Let's focus on what's important and why we're investing in the first place. Some of you are like, hey, I'm retiring next month, what do I do? But and there are things you can do and should do, and a lot of the same principles apply. But let me zoom in just for a second, and then we'll zoom back out, because you mentioned earlier that on average, almost every single year. In fact, this is from JP Morgan Asset Management. For those of you that are watching, it shows annual returns and intra-year declines. Intra-year meaning at some point, let's say in July, the market's up 15%. And then by the time August rolls around, it's down to 1% year-to-date return. So that's what intra-year means. So the chart, it says, despite average intra-year drops of 4.1%, annual returns were positive the last 34 of 45 years. So that means at some point in the middle of these years, there was a drop of a little over 14%, which is by definition is correction territory, but maybe it happens fast, recovers quickly. People don't even notice sometimes.
Yeah, most of the years it actually worked out in the end of the year, that is. I mean, if you look at the chart, the red is where it was, and then the black is where it finished. And most of the years it's positive. So that gets back to in January of, 2010, nobody probably remembers January. The market was down some point during that year. Let's say it was down 19% in January. Well, it finished up 0. So did the 19% even happen? It did, but you zoomed out.
Yeah. And yeah, let me see if I can zoom in really to, I think it's 2016, maybe. At some point during 2016, and we're showing this on the chart, the market had a correction of 11% down, but it ended up 10% positive. So this almost happens every single year. And this is a piece of perspective I think that can help people. Again, easy to say to say when times are good, but right now people are like, yeah, whatever, dude, the market's going down and it's scary. So that's the zoom in, Kevin, but let's zoom out like you suggested earlier. And right now I'm showing a 20-year history of Vanguard's S&P 500 index fund, because that's the one that has a lot of history, and I was able to show that. But if for those of you that are watching on YouTube, you can see the chart is just a trajectory upwards, right? An upward trajectory almost the whole time. You can see times of where it wasn't that way, but overall, if you drew a line, it would be pretty steep upwards. So, but Kevin, what do you think as far as this chart is concerned?
Yeah, I mean, 2008, 2009, we all cried. I saw clients cry. And now you look at it, it's just a little, I don't know what we call that.
Yeah.
a little impression in the ground.
Right, yeah.
It doesn't look like much now, but at the time it was really important and devastating.
Yeah, yeah. Look at 2020. I mean, it literally is a blip. I think 2020 is fascinating because it was very painful. market wise anyway. Obviously, a lot of people lost their lives. That was a different story. But market wise, it was very painful for a short period of time, and it recovered by the end of the year, which was like 5 years of history and market experience all in one. But there are times where you can see that the market either goes down for a little while, corrects back up, and it takes a little while to get back to even. But then again, there are new highs, and there'll be new highs again, and that's kind of normal.
Most likely.
Yeah, most likely. Thank you.
Yeah. So Charlie, let me thank you for that. Now let me ask, like, because people always ask us questions when markets go down. I've already heard it a few times. The first question is, should we just go to cash and wait for things to get quiet? So what do you think about let's go to cash?
Oh man, it sounds so logical and reasonable, right? I mean, here we are, we see whatever we look at, either statements or our, online, most likely on our phone, we see account balances going down significantly. And maybe some people listening now are close to retirement, and the most reasonable logical reaction is that we just remove everything, right? However, it's much more complex than that. And you and I have been on ends of conversations where, that's been the topic. And we know that it's much more complex to execute that. And we know by history, most of the time, those decisions result in more loss than the actual event itself. Again, that's what history has taught us. So those things are really hard to do. And here's another thing, Kevin, that we learned in 2020. We didn't have many, but when some people got out, there was actually more stress when they were out of the market than when they were in, because it was a different kind of stress, Kevin, because now it was, well, how do we get back in this? There's no signal. Nothing is wonderful right now. People are really, literally thousands dying a day. And we had other events going on during 2020, elections as well. There was no time, Kevin, that somebody wanted to get back in. So it was stressful now, just from a different perspective. And that was, interesting, unfortunate to see sometimes.
Yeah. So the stress of I got to get out is then replaced with I should have gotten back in as markets go back up again. And, Charlie, I'll tell you, 2011, 12, 13, 14, 15, we had a number of people that came to interview us. And they said, look, I got out in the big market crash of 08, 09. And I'm like, okay, so are you still sitting in cash? And they're like, yes. And so our recommendation was we need to figure out a way to get you back in.
Yeah.
And they're like, I'm not putting it all back in right now. The market is too high. So this idea of market high and market low, I think that's another topic that we need to discuss, because a number of clients have already said, and we think this way too, hey, the market just went down 10%. Let's buy when it's low. So is the market low? I mean, I'm asking the question because we don't know, right?
Yeah, there's no, there's no way to know that at that moment, and there's no way to know the bottoms until years after they've already happened, and the same as what you're talking about as well. But Kevin, you talked about step one, zooming out. To me, that's planning, like we talked about, having the right perspective, going back to what your goals are, and then step two, to me, is I wrote something kind of clever maybe, but take the power back, right? I think it reminds me of Rage Against the Machine. Remember that Rage Against the Machine song? You're like,
Yeah. I don't, but anyway, I missed that was the dark years.
Everybody loves Rage Against the Machine, right? But anyway, take the power back. But really, what we're saying there is control what you can control, and again, we see this over and over again, and we see people that have savings, liquid savings, emergency funds. That brings comfort. And again, we don't always know exactly the emotional, part behind that, but it does. We see that over and over again. I feel it myself, Kevin. Like if I go into some of these downturns and I have low debt and I have a good, healthy savings account outside of retirement that I can access if I need to, that just makes me feel better and withstand these times better. So we do have some control during these times, and I want us to focus on the things that we do have control over, because there's some that we just don't, right?
Oh, absolutely. And a bell is never rung when the market hits the bottom. A bell is not rung when it hits the new high. It is. People say, "Oh, we just hit a new high again." But trying to take control over that, it's an uncontrollable event. So I think that's really the bottom line with that, is that's not controllable. I think really the only thing we can control, Charlie, is the way we think, and how and we control a little bit about how we feel by the way we think. And so that's where like we talk to a lot of clients, and sometimes we talk to a client and we don't know them very well, and we say, "Hey, how you doing with the market volatility?" They're like, "What volatility?" And they're like, and then we tell them, "Oh, the market's down 20, 30, whatever percent that's happened in the past." And then they're like, "That's okay. I have a fundamental belief that markets will come back." So that's where I say, like, if you don't believe, act as if you believe in the periods of dark days, because that's really the best way to emotionally get through it. Now, if you're wrong and you should have gotten out, you couldn't predict that.
Yeah.
You couldn't predict that.
Right. Yeah.
So, Charlie, the next book club we have internally, I might make a recommendation, and I'd like to just recommend this book and other books like it for people that are listening. So it's called The Investor's Manifesto. And this was something that actually got me through the 2008, 2009 crash. It's funny when I listen to people talk about the crash in 74, I'm like, dude, you're so old. So maybe people are thinking that with the 2008, 2009. But another old guy, William Bernstein, was a former neurologist, wrote a bunch of books. I love him. This book came out in the beginning of 2010. And the reason why he wrote this book, he said, I already wrote everything I know about market history. But he wrote this book because so many people were so despondent and did not want to invest ever again. And so he gives a number of examples about like how doing the right thing in the past has really been a good thing. And by doing the wrong thing, you just get screwed time and time again. So I'd like to just share one anecdote that he has in the book. So Charlie, he likes to talk about these anecdotes, and this anecdote I found to be like a thought experiment. I found it to be fantastic. So he says in 1999, a blackbird comes to you, and he always talks about blackbirds being like bringing poor tidings and harbingers of negativity. And so he says the blackbird tells you you're going to have two market crashes in the next 10 years, two big market crashes, but he doesn't know when. And so what do you do when you find out that you have a harbinger of ill tidings coming at you? Do you still stay invested, knowing that there's going to be two major market crashes? When I say major, the first one was the .com crash. Peak to trough in large companies was down 45%. And then the second one was the 2008, 2009. Now, his data is a little skewed here because he wrote this in 2010. So he didn't have all of he was writing this during the 2009 year. But anyway, long story short, if you're watching on YouTube, you can see the different asset classes that were down from September 2000 to 2002. 45% downturn, large cap value down 10%. Small companies were actually up. Emerging markets down 26%. And guess what did well, Charlie? Bonds.
Look at that. Yeah. Can
Bonds
you expand that a little bit? There you go.
Okay,
That helps us old guys.
Yeah, so then the second market crash, you can see some of the things like REITs were down 55%, international companies down 56%, emerging markets down 62%. I mean, man, oh man, this was huge. But again, if you got out because you wanted to avoid these two, what you ended up missing, January of 1999 to the end of the data set here was December of 2008. You ended up missing tremendous performance. This is also a lesson on diversification. Large cap was down 14% during that time period, but large cap value was up 24%. Small companies were up more than 100%. Real estate investment trusts up 100%. Emerging markets 100%. You get the idea. Yeah. Everything else was up tremendously during this time period. So the point here is, again, find things that can help you to zoom out. If it's not this Investor Manifesto book, and if you have ideas, please put them in the YouTube comment section. I wanted to get people interested in commenting, Charlie. That's supposed to be a good thing. But if you have ideas about how you can help yourself to zoom out, we would love to hear them.
Yeah, that's good. And Kevin, that chart was fascinating, and you showed the one of those that was down. I think it was large US that was down during from 99 to 2008. Okay, so that was the data set that you were showing there. Actually, large value was up, small value was up, because that was the lost decade of the S&P 500. But if you were diversified, then you experienced those gains that you just talked about, which was pretty fascinating, how you could go through that decade. And that's when I started investing in 99. So about 2005, I was done with the S&P 500. That thing was terrible. But obviously, diversified portfolio, you did pretty well during that time, during that decade. So,
Charlie, my final ask to people is that if you are upset, or if you find yourself going to a dark place with your investments and you're just ready to pull the plug, talk to someone who, not the person that's a conspiracy theorist, but talk to someone that really doesn't get as much fear with investing. If you have a planner, obviously talk to them, call us, but talk to someone. We are social creatures. Hopefully you'll go for a walk and talk to somebody, and things won't seem so bad.
Yeah, there you go. And I love it. It's interesting, Kevin, this podcast will come out in a week and a half, and we have no idea what markets will do between now and then. They may go down more, and they may be up tremendously by that time, right? Yeah. We have, at any point in time, there is no indication of what that next week or next month or next year looks like. So, but there is a good indication next 20 years looks like, right? We've had that as his history to help teach us. So, but thanks, Kevin, for coming out of the tax save to help us out. And your perspective today was really helpful. So we appreciate all of you, our airline pilot, professional pilot, fractional pilot, corporate pilot, military pilot, and even non-pilots. Kevin, we have a lot of non-pilots that listen, and a lot of pilot spouses listen in to go, hey, this is what my pilot spouse may be experiencing. So anyway, I've got some of those as well. So thanks for listening. Don't forget to give us a rating and review. We appreciate it. Check out the Pilot Wealth Index. And please don't hesitate to reach out to us. You can reach out to me via email, works pretty well, at charlie@leadingedgeplanning.com, kevin@leadingedgeplanning.com, or if you're too shy to reach out to us directly, go to info@leadingedgeplanning.com. We'd love to hear from you. And thanks again, and see you next time. Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out, give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie@leadingedgeplanning.com. Again, that's Charlie@leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.